Breaking news just in. Reliance Industries has reported their Q1 numbers, and we have a couple of numbers that are flashing for you on your screen. Prima facie, the first number that we have is the net profit number, which is down about 11% year on year, coming in at 16,000 crores, a little above 16,000 crores. Now, on a quarter-on-quarter basis, of course, that's a fall. But if you look at it on a year-on-year basis as well, it's a fall of around 11% year-on-year. Now, this time around, we are expecting a mixed bag in the earnings. The refining business has been under a bit of pressure, but the consumer businesses have done fairly well, while the E&P business has also done well. So just awaiting some more numbers. The first number that we have, 16,011 crores on the bottom line, which is a downtick of 11% on a year-on-year basis. Any more numbers that you guys have?
Well, I am just looking at the profit number and why it could be impacted as well. The depreciation and interest costs, they are higher on a YOY basis, and this is one of the reasons why it would have been lower on a YOY basis. Apart from that, EBITDA is largely flat on a quarter-on-quarter basis and on a YOY basis as well. But let me talk about the oil to chemicals business, because that is the one which has seen a decline on a YOY basis, and that is largely led by the refining segment. And there is a reason to that, because if you look at the product cracks as well, they were at a record high in FY23. I just took an average last year how these different products have really performed. The gas oil cracks on an average were at $40.68 per barrel, which have now fallen to $15.5 per barrel, but those were abnormal levels. The average so far has been around $14 to $15 per barrel, and that's why you've seen a fall that has come by in Q1. But overall, yes, it is a fall on a YOY basis in terms of EBITDA and margins. However, these are normalized numbers if we compare it to the previous years.
Okay, the overall numbers, I just wanted to put them on board. If you look at it, the revenues have come in at 2.07 lakh crores. This compares to 2.19 lakh crores same time last year. But there's actually an improvement in the EBITDA on a consolidated basis. The EBITDA margin on a consolidated basis year on year has improved to 18.3% versus 17.3% same time last year. And the core EBITDA has also seen a mild improvement compared to what we saw last year at 38,093 crores versus 37,997 crores. So as we've been telling you, it is a mixed bag. While the oil to chemicals business has been under pressure, the consumer businesses have actually offset the pressure there and have picked up, leading to an overall improvement that we've seen in the operational performance. But Mangalam, any more details?
You said the EBITDA has improved and the margins, right? I would attribute that entirely to the consumer business. And there's been a phenomenal growth in the company's retail business EBITDA. Year on year, there's a 34% jump in their EBITDA, and there's a jump of 20% in their revenue. So we're talking about nearly 70,000 crores in the retail top line. So 69,962 crores to be precise. This compares with 58,560 crores same time last year, and consumer sentiment has improved. Along with that, the company's increased store footprint and operating leverage has resulted in their EBITDA margins expanding as well. So year on year, there has been a near 80 basis points expansion in their EBITDA margins. That's a 34% jump. Whereas quarter on quarter, there's still a 30 basis points jump. And these are, huge bases that we're talking about. Close to 70,000 crores on the top line and 5,151 crores in the retail EBITDA, coming in at 7.4%. So strong business, strong performance in the retail business. No real doubts here. I mean, good numbers.
Okay, I just wanted to make one point on the oil to chemicals business. While it is seen a decline on a YOY basis, it is much better than what Kotak Institutional Equities was expecting in terms of EBITDA as well. Kotak Equities expected an EBITDA number of 14,972 crore rupees. The company has done an EBITDA of 15,271 crore rupees, and this is at a time when we have seen normalizing of margins on a YOY basis. Even the oil and gas business, Kotak was expecting an EBITDA number of 2,737 crore rupees. The company has done EBITDA much higher than that. It has come in at 4,015 crore rupees, which is an increase both on a YOY and on a quarter-on-quarter basis. In fact, their margins have come in at 87% in the oil and gas business, and that looks like a multi-quarter high coming in this business.
Okay, so just to summarize the numbers up until now, it is a pretty steady performance that you're seeing from Reliance Industries. On a consolidated basis, there is an improvement that we've seen on the operational front. The core EBITDA on a consolidated basis has improved to 18.3% compared to 17.3%, and this is largely led by the consumer-facing businesses, primarily the retail business, which is growing at a very sharp clip. Remember, let's not forget the stock has had a very strong run as well. It's up 30% from the lows that we saw in in the month of March and is sitting at a 52-week high. Abhijit Bora, the Associate Vice President at Sharekhan, is joining in. We have Prakash Diwan who's joining in as well. Prakash, thanks for being with us on the show. A pretty steady show from Reliance Industries this time. Of course, you know, some bit of dip as far as the oil to chemical business is concerned in certain pockets like refining, but otherwise not too bad at all. Consumer business is doing very well. What's your take on the earnings?
So I think it's far better than what expectations were. While we knew that some of the old businesses would be struggling a bit in terms of growth and margins, those margins also aren't something you would complain about. And Singapore CRMs were anyways really down almost 50-55% on a Q-on-Q basis. So that was penciled in. But in spite of that, the O2C business overall also, if you see, thanks to Petchem, which has been soft traditionally for this quarter, that's also done pretty well. My biggest take is the last 3 quarters you've seen this is probably the third quarter that retail and telecom have started becoming the growth engines, and that's where all new capital has been deployed. So which means from an ROC perspective, you start seeing improvement incrementally on the entire consolidated basis. That's going to be great news for long-term investors. So absolutely in line on terms of expectation. I mean, you could keep on picking holes in something or the other depending on what your view or long-term view is, but 30% of a rise has been more of a catch-up play on Reliance, and it is a lot to do with the demerger of the financial services piece. But I think these numbers will restore confidence in the core business as well, minus the financial service.
Abhijit Bora, Associate Vice President at Sharekhan, is joining us now as well. Abhijit, what do you make of the oil and gas business? Because that has fired on all cylinders. In fact, if I was looking at the margins as well, it must have come at a multi-quarter high as well. Do you think with the commissioning of the third cluster in the KG-D6 basin as well, there are more triggers for the numbers that we have seen in the oil and gas business?
Yeah, definitely. If you see the standalone EBITDA came at around close to 16,361 crore, a beat versus our estimate. And we believe that this was largely to do with the better petchem margins as well as some benefit of discounted Russian crude in the GRMs. And with the MJ field coming on stream, the oil and gas E&P business would also see ramp up in the production to 30 mm SCMD from currently around 18 mm SCMD. So that will also add to the earnings of the oil and gas standalone business. So we see this as positive coming up for these are very good set of numbers on the standalone as well as the consolidated financials.
All right, Abhijit. Prakash, coming back to you on the retail business, the margins are at an all-time high for their retail business. Earlier everyone would wonder whether at scale the company would turn operationally profitable or not. But increasingly the company has shown strong operating leverage, and with 70,000 crores of quarterly revenue, they've turned in margins of 7.4%. I was just looking for perspective, and DMart reported revenues of almost 11,000 odd crores, and they, being known as one of the most efficient companies in the retail space, have reported margins of 8.7%. So at 70,000 crores, 7.4%, the street would not only take it with both hands, but wonder how much better it can get from here at this base.
Absolutely, and if you add one more point on that, Mangalam, which is the kind of entry barrier that they've created. I mean, when you have a footprint which yields you this kind of revenue in a quarter, the kind of store presence that you have, it's extremely difficult for anybody to come and unseat you from certain markets, right? And that's exactly where your operating leverage starts coming in. And what's happened in this quarter on the retail, and once you go a bit more granular, you'll realize they created a lot of, the mix in terms of retail offerings was very wide. And this quarter, they've started creating depth in that. So just to give you an instance, for example, if they had something in the children wear business, they would add 2 more labels. If they had something on certain product categories like personal hygiene and beauty products in their stores, they would have more. So there's more work that's happening which will deepen that retail piece and expand it. So I'm sure just 20% growth is a start. It could be definitely higher than that in the next few quarters.
Okay, so apart from the P&L, even the balance sheet for Reliance Industries has been improving substantially. Now they speak about how their net debt is flat on a quarter-on-quarter basis if you adjust for the JFSL demerger. So that's the other fine print from their numbers. Remember, both capex and net debt trends are improving for Reliance Industries. They have the ability to fully fund the capex, whatever it is, for the new energy businesses through internal cash generation. And the net debt to EBITDA for Reliance Industries now remains quite low if you compare it to the peak of the capex cycle that they had between FY12 to FY17. So not only is the P&L improving across businesses, but the balance sheet has also been improving for Reliance Industries. Devin Choksi is joining in, the managing director at KR Choksi Securities. Devin, a strong set of numbers. There's an improvement in the operational performance overall. The consumer-facing businesses are picking up in a big way, with retail seeing a 20% revenue growth. How much of this you think is in the price already? Because the run-up in the stock has been fairly sharp as well. And what do you see the reaction on Monday?
Good evening, Sonia. Well, I think first and foremost, I think retail business is definitely, I think, moved up very, very sharply. Not though completely surprising, because I think the way in which the company has been acquiring their brands, their own brands, and I think those brands also have actually started contributing not only to the revenue but also to the margins. So that is something which is, I think, happening positively, and I think as can be also reflected in the EBITDA and EBITDA margins. I think about 5,100 crore EBITDA and about 7.5% EBITDA margin in retail, which I think extremely positive direction that this particular vertical is assuming. Second one, I think, is digital services, I think, which is a Jio platform particularly. And that is where, again, I think the numbers are actually very, very convincing and smart. Already they have come to the yearly rating of 50,000 crore EBITDA. And in my understanding, Jio Bharat, once it gets steps off completely with the rollout, in my viewpoint, I think holds the possibility of, I think, contributing another 10 to 12,000 crore of EBITDA into it. So I think the growth in this area also, I think, looking extremely convincing. And now the oil and gas has also started contributing relatively more compared to what it used to be, because of the newer oil fields which have gone into the production. And that's where the higher amount of profits of around 4,000 plus crore EBITDA is also being seen. So overall, I think the business has been, I think, absolutely convincing. Maybe some kind of a dent has happened due to the O2C business, which has possibly, I think, due to the GRM fluctuations, which has probably created this problem. But I guess I think it should get normalized in subsequent quarters.
Devin, in fact, in this quarter, we've seen some normalization of GRMs as well. If we go by the last 3-year average, they are around $15 per barrel, and that's what the case has been in Q1 as well. FY23, of course, was record high GRMs that we saw, going up to levels of around $40 as well. But oil and gas business as well, as you said, firing on all cylinders. I was just going through the press release. They spoke about how higher volumes and higher realizations have led to this beat that we have seen in the oil and gas business. Of course, we'll discuss that in greater detail. But Rima is joining in as well with her take and analysis on Jio's numbers. We have more details here, Rima.
Thanks so much for that. So Reliance Jio has clocked in a steady quarter. Double-digit revenue and EBITDA growth on a year-on-year basis. Revenues have gone up by nearly 3% quarter-on-quarter. On a year-on-year basis, they've gone up by 10%. And even as the top-line growth has increased by 10% year-on-year, the EBITDA growth is far more at 15%. So the performance in Q1 has been steady, double-digit revenue and EBITDA growth on a year-on-year basis. The two internals that we track for Reliance Jio, one is the pricing, which comes under the category of ARPU, average revenue per user, and the other one is volumes, which comes in the form of subscriber growth. Now, both these metrics are trending in line with street expectation. Subscriber growth in the current quarter is 9.2 million subscribers. In the month of April, they had added about 3 million subscribers, so I'm presuming a similar run rate continued in the month of May and June, and 9.2 million subscribers added on a quarter-on-quarter basis, and 28.6 million subscribers added on a year-on-year basis. So pretty strong subscriber addition. In fact, the subscriber addition in the current quarter is the highest that we've seen in the last 4. So that's a positive. ARPUs, we haven't seen any big, broad, price increases. Despite that, the ARPU for the company continues to tick up, bit by bit. So in the current quarter, the ARPUs have gone up by 1% QOQ, and on a year-on-year basis, they've gone up by 2.7%. It's come in at 180.5 rupees per month. So in a nutshell, Reliance Jio has also clocked in steady growth, a top-line growth of 10% on a year-on-year basis. This is roughly driven by about a 2.7% price increase, ARPU addition, and about a 7% increase in the company's subscriber growth on a year-on-year basis. So it's a steady showing from Reliance Jio as well. Prakash, you want to comment on the subscriber growth, because it's looking very robust. 9.2 million subscribers added on a quarter-on-quarter basis, and plus now you're going to have the Jio Bharat phone, the smartphone, fairly affordable at the price range. So the subscriber numbers could just be ticking up and ahead of competition.
All right, Prakash, can you hear us? Okay, we'll do one thing. We'll go back to Prakash in a bit. We also have Sudeep Bandyopadhyay, who's joining into the conversation. Sudeep, thanks for being with us on the channel. This is looking like a very strong showing, right? Across all platforms, across businesses, things have picked up. And there are many positive triggers as well from here on for Reliance Industries, whether it is the new energy business, whether it is JFS and the eventual listing there. Do you think these are enough for a re-rating of the stock? And what would you do in terms of earnings? Would you raise your EPS estimates or even your target price on the stock post these numbers?
Absolutely. In fact, I've been positive on Reliance for some time, and I've been maintaining my view that the value unlocking opportunity inside Reliance Industries is humongous. We've just seen the Jio financial, segregation happening. But I think the big, deal for the investors will be when Jio platforms and the retail gets segregated. And at some point of time, maybe even the green energy business also will get separated. These will be huge value unlocking opportunity and, really, really big boost as far as the shareholders are concerned. So we haven't seen the entire thing getting played out. I think we are just seeing the trailer. So as far as I'm concerned, for a long-term investor, he should definitely have Reliance in his portfolio. If it doesn't have yet, he should go and add, as soon as he can. The retail numbers were fantastic. I think none of us expected these kind of numbers from retail. I think, you were talking about DMart and DMart's margins. Considering the volume which DMart does and Reliance Retail has done on a 70,000 crore volume, maintaining at 7.5 kind of margin is fantastic. And we know how this is being built, the kind of spread, the kind of acquisitions through which they are building the retail muscle is amazing. As far as Jio is concerned, I think we have seen fantastic customer additions, but the Jio Bharat can be another big game changer where the 2G customers of the other operators will probably start migrating, and that is the objective. And that will be a huge boost to Jio in future.
Right.
Of course, we'll have to wait and watch for the AGM announcements on green energy and maybe financial services to understand and appreciate those fully.
Yep, that seems to be the next big trigger. In fact, they opened 555 new stores in this quarter as against DMart's current total stores of over 327 itself. 250 million footfall. So good business across the board, especially from the retail business.
Oh, absolutely. And as Sudeep was saying, right, this is just the trailer. Picture abhi baki hai, perhaps. Well, on that note, thanks to our viewers and thanks to all our guests for joining us as well. We'll wrap up with the note that Reliance Industries, very strong operational performance coming in across businesses. They have improved. The retail business is shining bright with over a 20% growth that we've seen in the top line. Jio has done very well with a good subscriber addition, and oil to chemicals business not as bad as what the street was estimating. So overall, good set of numbers coming through. Thanks for watching. Take a quick break and be back.